You may be familiar with this rule in the investment world where risk is very tied to the return that we can expect from an investment. So for example, we are usually expecting a higher return from investing in stocks than from investing in bonds, which is very safe. This may lead you to believe that investing with higher risk is always the best. But the return on an investment is hardly the only thing that we have to keep in mind when selecting an investment. If we want to invest successfully, whether it be with low or with high risk, we should create a strategy that we can easily follow and that allows us to take as much risk as we can take, but nothing more. Or at least that is the strategy that most people should follow. But for those of you who might want to take more risks from the get-go, I'm going to talk about an aggressive strategy that you may also want to follow. Hello, my name is Eduardo Rosas. I have a finance degree and I am currently pursuing my master's degree in financial planning. And on this channel, I talk about everything that we should know about personal finance. So if you're new here, consider subscribing. In this video then, I want to talk about these two different investment strategies that we may want to follow depending on the risk that we want to take. So we're going to have a normal strategy, the strategy that most people would want to follow. This has a risk curve similar to this one. It starts with as little risk as possible, slowly builds up to as much risk as someone can take, and then starts to go down again as that someone starts to age. The idea here is that we start with something very, very safe, like bonds from your country. The return on those bonds are guaranteed by your country, so it is fairly reasonable to expect that no matter what happens, you are going to get that money. So that is very safe. So that is as little risk as you may be able to take. So you start very close to zero risk. And you start to slowly build up that risk by adding some investments in stocks. So for example, you may start with a distribution of 100% in bonds and then move to a distribution of 90% bonds, 10% stocks, perhaps using something like the S&P 500, using an ETF like VOO. And so on and so forth. You would go 80-20, 70-30, 60-40, up to the point where you cannot take any more risk. Up to the point where you decide that the risk that you're seeing or the volatility that you're seeing, the daily changes or monthly changes in the value of your investment is more than enough, that you can't take no more. And that's it. Eventually, little by little, you start to remove risk again as you age. Because as we age, we are going to notice ourselves that we tend to want to take less risks, whether it be because we have more responsibilities or because retirement is getting closer. The idea of following this first strategy is that you never take more risk than you can take. So there is never a question as to whether you're going to continue investing or not. Because if you were to take more risk that you can take, it is plausible that you find yourself in a situation where you feel fear and you no longer want to invest. You claim that investing is a scam, that it is only for millionaires, and you withdraw all your money, run away, and never invest again, which of course has terrible implications for your personal finances. If you never put yourself in that situation of fear, you will continue to invest and you're going to be very successful. You're going to save and invest a lot of money if you continue to do so for decades. But there are some people who may feel entirely the opposite when taking so little risk. They get impatient, and they're in their impatience because they don't see their money growing, or they don't feel like they are actually investing. They don't feel like they are taking risks. They withdraw all their money, go and spend it, go and invest it somewhere that might be a scam because someone is offering incredible returns, and lose their money, claim that investing is a scam, claim that it is only for millionaires, never invest again, have a terrible impact on their personal finances. For those people, it is better, much better to start with an aggressive strategy, perhaps to as close as 100% risk as possible, and then start to remove that risk. In fact, those people may want to start not with the S&P 500, but with something like the Qs. QQQ is an ETF that invests very heavily in technology. This means that it has given incredible results for investors because it has grown so fast, but it also has a lot of volatility. So an investor should really only consider investing in the Qs if they know that they can continue to power through moments of volatility where they might lose 25 or 30% of their investment. Similar actually to what happened to the Qs in 2022. The curious thing is that precisely new investors might be particularly well prepared for taking these risks, which is odd. New investors normally, you would think, invest adding risk little by little, baby steps, starting investing in something that is safe and little by little starting investing in something that is less safe. But it turns out that seasoned investors, people who have been investing for years or decades, might find themselves looking for less risk. How come? Well, because they have amassed so much money that even little movements in the market mean losing a ton of it. For example, if someone has already the equivalent of 5 years of their own income, a 20% drop in the market means losing 1 year of their income. That is huge. That is a big blow and it will feel terrible. The same 20% fall for someone who has just started investing, maybe has 1 month of their salary invested, is the equivalent of losing about 4 days of income. It's not that bad. So these people who are just getting started are particularly well suited to start investing in something volatile like the Qs, provided they know that they should power through the volatility. In any case, it is much better, and everyone should know that it is much better to invest with normal returns, with low medium risk for 20 or 30 years than to invest with the best returns, with the highest risk for only 6 months. So if you know that you can take the risk for the long term, or that if eventually you have to take less risk, you will have the time to move to a less risky strategy, you can go ahead and use the second strategy. Start with the Qs and little by little move to adding bonds to the mix. But if you just really want to take those baby steps, add risk up to the point where you can take it, then it is the first strategy that you should follow. So anyway, there you have it, a quick, very maybe not so quick video about these two strategies that you may want to follow with investing. I hope that they have been useful, and I guess I might catch you on the next one.